Have you ever felt like you're getting taxed to death by the IRS? If you're like a lot of our business owner clients, you've often wondered to yourself, I've reached this level of success, but is it even worth reaching that next level? Because every time I earn another dollar, I feel like I have to give half or more of it back to the IRS. And who likes doing that? A number of people who work with us have asked us, are there some things that I just don't know about or other business owners do that I'm not doing that helps them save on their tax bill and get them closer to their financial goals? And if so, how can I take advantage of that? Well, if this sounds anything like you, or maybe even someone you know, you're going to want to listen into today's video on the Financial Prof series, as we're going to go through 5 signs that you might be overpaying in taxes and a few things that you can do about that. Hi, I'm John Norberg, and welcome to the Financial Prof series. Okay, so 5 signs that you're probably overpaying in taxes, and a few things you can do about it at the same time. Let's go through it. Okay, so number 1, you are consistently surprised by high or unexpected tax bills. So this would indicate that you probably want to meet with your CPA, your financial advisor, your bookkeeper, and really get dialed in. You'll be able to better anticipate, better save, and perhaps take advantage of certain time-sensitive deductions and credits that would allow you to have a better idea of not only when taxes are coming, but what you're getting taxed for and taking advantage of those things along the way to help bring that overall bill down, hopefully. Okay, number 2, your CPA or financial advisor only contacts you once a year. If you only hear from them, once a year at review time or at tax time, then it's probably time to do a little bit more of a strategic type of meeting. This is something where a good CPA should be meeting with you, a good financial advisor should be meeting with you multiple times throughout the year to review your financial situation. And again, take advantage of certain situations that might come up which have a certain clock attached to them that by the time we get to tax day, it's way too late to take advantage of. I'm reminded of, say, for instance, being able to contribute to a SEP IRA. There are deadlines attached to that. Or, for instance, to be able to set up a solo 401k. There are deadlines attached to that. And a lot of this has to be done before you actually write that final check to the IRS on April 15th. If that's the case and you've already hit that deadline for this past time, not to worry, there are some things that could potentially be done still, but that doesn't mean that you shouldn't be meeting with your professionals on a semi-regular basis so that you are taking advantage not only of their expertise, which you're already paying them for, right, but also making sure that any time-sensitive tax tips, techniques, financial planning topics that come up, you're able to take advantage of in a timely manner. All right, number 3, you haven't reviewed your business structure for years. So having a business structure is obviously kind of paramount to having a business, right? But having the right business structure can make all the difference. I'll tell you a quick story. I was working with an optometrist who was wondering, okay, I have been in business for probably 30 years or so, and I have this C Corp. And it's basically what at the time their attorney told them they ought to set up. Got it set up for them, and they haven't touched it or really even thought about it since. Now, there are certain advantages that come with owning and operating a C Corp. For instance, a health reimbursement arrangement, for instance. That's really cool, but a lot of the times it doesn't necessarily compensate for the fact that you're usually being double taxed because you're being taxed at the corporate level as well as the personal level on any revenue that that business generates. Whereas maybe a pass-through entity, like an LLC of some kind, or an S Corp election, might make more sense. So semi-regularly meeting and reviewing with your attorney and or financial advisor, CPA, etc., ideally your whole team, what that business structure looks like, and if indeed, given the changes in law, in taxation, and also your personal life, that structure still makes the most sense, really good idea. In the case of this particular optometrist, we were veering towards an S Corp when it was last addressed with them. So this is something that they themselves realized this is something we might want to rearrange, make it a little bit better, a little bit more advantageous as we prepare to move towards our next chapter of business, right? All right, so number 4, you're not taking advantage of the available deductions and credits that are out there. And there are so many of them. We've talked about a lot of them on this channel, and some of them even have a lot to do with tip number 3 that we just talked about, which has to do with your business structure. For example, being able to hire your children. With an S corp, it's not really feasible to do that necessarily because you have to run all that pay through payroll. But maybe having a disregarded entity, such as a family management company in that case, that is not an S corp, could make a lot of sense. But the whole idea here is that there are a ton of deductions out there that people just don't know about, they just don't take advantage of, or if you are smart and you are taking advantage of it, that's likely because you are doing these things, meeting with your team, reviewing your business structure, making sure that you or someone whom you work with, again, like your CPA, like your financial advisor, is keeping on the up and up with changes in tax law, changes in business law. I'll give you a quick example of that right now. We are coming up on, and this actually plays into the next tip, but we're coming up on the sunsetting of the Tax Cuts and Jobs Act here at the end of 2025. That has so many implications that we'll talk about here in just a minute. But the idea is that there are so many different deductions out there, and I think a couple of the most common ones that I see missed are making sure you're actually fully deducting your mileage, making sure that you're actually fully deducting electronics. So that could be cell phone, laptop use if it's for business. Anything that you purchase for home office use is probably, at least in some form or fashion, deductible, worth checking with your CPA on. Now, this might sound like small stuff, but it adds up. Another quick example, and then we'll leave this particular tip behind, as to the ability as a business owner to rent your own home back from yourself. So if you're successful, you probably have a good sized home, maybe in a nice, desirable area of the country. And if someone were to rent that home from you, it's probably going to cost a pretty penny to do so. Well, if your business rents your home from you as the individual for 14 calendar days or less in a year, guess what? That's tax-free income to you as the individual and a deduction to the business. So you get a win on both sides, personal and business. This is an example of one of those deductions that just doesn't get talked about enough. And if it is talked about, it's oftentimes in a kind of catchy, hey, you should do this, without actually implementing it properly, kind of like hiring your kids. So good to have a good team behind you that can help you figure out if this is a good fit and how to actually implement it, right? All right, so this then brings us to number 5, which is that your tax strategy hasn't adapted to changes in the business and tax laws. So again, we hinted at this just in tip number 4, but the Tax Cuts and Jobs Act is an enormous one. For one thing, we're going to see the sunsetting of the QBI, Qualified Business Income Deduction. The estate tax exemption is set to get cut in half. All of our, or very nearly all of our tax rates are going to go up by at least 1% or 2 or 3. Corporate tax rates are going to go up. There are a number of different tax rates that are currently set to bump up, sometimes by only a little bit, but sometimes by a good chunk. This is something that you want to make sure that you're aware of, that you're planning for, or perhaps more specifically, that the team you've hired is aware of and planning for you. And if that team is not doing so, and if they're not proactively reaching out to you, if they're not letting you know that, hey, this is on the horizon, and yes, it might change depending on how Congress acts, but we're aware of it and we've got a plan for it, then it might be time to take a look around and see, okay, well, do I need to change out members of that team? Do I need to bench a few and bring in a few fresh pairs of eyes, a few fresh players, if you will? So that's where we at Norberg Wealth Management really come in. We like to work with business owners because there are so many different moving pieces to that plan. And if that's something that, again, you've thought about, or maybe this video has made you ponder on, then we'd love to hear from you. Drop us a line, click the contact link in the description, and in the meantime, if you could give this a like and subscribe so that you never miss another update from the Financial Prof, we'd be very appreciative. And in the meantime, I'll see you out there.